And the war in the Middle East has all but closed the Strait of Hormuz. Here to give us some insight on that is Andrew Cire. He is an associate professor at the Department of Management at the University of Toronto and the Rotman School of Management. Andre, thank you very much for joining us today.
Hi, it's a great pleasure to be here. Thank you for having me.
It is an interesting time with this closure. I want to talk about it a little bit. Why are Canadian oil prices so affected by something that's only just happened, and yet we still have tons of oil here that we haven't used yet?
Yeah, absolutely. That's a great question. I think everybody's asking this at the moment. And indeed, Canada is a net producer of oil, of crude oil, and it's benefiting in some ways. You can see that the price is also going to definitely benefit Alberta. But it is a paradox, it's a contradiction. What happens is that oil is a global commodity. And because it's a global commodity, it's going to be traded it's going to be traded by international benchmarks, international indices. You mentioned Brent. There is also the WTI. So even though we are exporting oil, we're definitely going to have to pay international prices for it, because in a way, also we are importer of oil. For example, we still need to buy refined oil from the U.S. around 30%. And we still need to buy internal oil for every purpose that we have here in Canada. So even though we are net producers, we just still need to import oil. We still need to buy international prices because it's a global commodity.
Professor, what's your view on the insurance system? There were chatter that there is potentially going to be government-led insurance to allow the ship to be carrying oil outside of Hormuz. How credible do you think that is?
I do think it's credible. I think there is a big effort we heard this during the weekend, I imagine, that the United States is willing to provide some insurance. Because what's preventing, one of the reasons that is the ships are not flowing through the Strait of Hormuz is because the insurance companies, they are reducing the level of insurance, they are reducing their what they can cover at the moment. And this is definitely one of the big blockades at the moment. So definitely there has to be a negotiation with insurance companies. And I believe it's credible. If the situation persists for longer, it's likely that there will be some effort there by countries such as the U.S. to help that situation with insurance companies for sure.
And if the U.S. does do that, where does that leave the insurance companies? I mean, they don't want to send ships that run the risk of sinking and the disaster that would be. And I know they wouldn't have maybe be on the hook for the coverage of it, but they'd still be involved in this.
Right. So I must say that this has not yet been very well defined, right? There's still rumors and it's really complicated now to know. There's so much uncertainty in so many different levels in terms of the insurance. We only know that there is some discussions now. How is that going to work? I would imagine, if I were to speculate, which is a big mistake of my part probably, is that this would be a temporary solution, and definitely it's just to make sure that some flow is going out of the Strait of Hormuz for sure.
What's your view? So Hormuz is about, let's say, give or take 20% of global production of oil on a daily basis, right? So what do you think the GSET reserve, strategic reserve, can make up of that? My view is that it's not going to be sufficient, but you're the expert. So do you think it at least give us a few days, a few weeks in terms of supply?
Absolutely. There will definitely be... So when we think about markets, right? So we are in this situation now where we are cutting supply very aggressively because of the Hormuz closure. Virtually it's closed, right? It's 80% reduction capacity, and we have still demand at the same levels that we had before. So by putting more oil into the market, by providing the supply from the reserves, we can maybe improve supply a little bit so that we can try to reduce those costs. Now, I think that it can work temporarily, right? For sure, it can help reduce the price temporarily, but it always depends on how long this conflict will continue. So if it continues for a long time, I agree with you. Then it's going to be complicated. We're going to deplete our reserves. Another thing that can happen is this country is also going to start looking for other markets. For example, maybe Canada can help there. The only issue is that the consumers here in Canada would also suffer, right? Because we're going to export more of our oil. But at the very least, we know that Canada is this countries, they're going to look for more stable countries like Canada, where they can have some stable supply. So I agree with you. It would be a temporary solution. It would definitely help reduce some of the anxiety that we are experiencing. But in the long term, I'm not sure if this is the optimal solution.
And you mentioned with Canada being a possible source, but they also are going to look and go, Canada can't really supply Canada. We don't have the capabilities right now to get any more out of the ground, do we? Or minimal more?
Absolutely not. So Canada, as you know, we are on the west, we are big producers of oil, Alberta, as everybody knows. And on the east, we are just big consumers, right? We have Ontario, Quebec, everybody wants to consume those oils. And it's surprising that it's cheaper to import oil from the U.S. 30% is easier to import oil from the U.S. than from Alberta, and also refined products and refined oil products, derivatives, and so on. So we do not have the capability, and something that we have been discussing this last few years. And I hope this brings this discussion back to the top of our minds of how can we integrate the provinces, for sure.
And just how long would this have to go on in the Middle East and the Strait there with the shutdown for Canada to actually benefit, where people would turn to Canada and take a look? I mean, because a lot of people I think are looking, this could be over in 2 weeks, could be over in a month. How would it have to go? Would this have to go a year, and then people would start to want to invest in Canada with this?
I think because it would not be short. It would have to be a few months. I'm not sure if it's a year. It's just too hard to estimate at this moment. Mm-hmm. But it's a structural change, right? So it would have to take some time. And everybody's not... I think there is a sense now of not taking risks, because we hear from the U.S. administration that this would be limited in time. It's not going to be months, but at the same time, we hear rumors that it would take a long time. So it's similar to the tariffs, right? Everybody's concerned, should I build the factory here or not in the U.S. because I don't know if the tariffs is going to remain the same, going to increase, somewhat the same. We don't know whether the oil price is going to stay that high for so long. It is not good for multiple reasons that it doesn't, because, for example, we are cutting supply to Asia by 70 to 80%, right? Japan is heavily dependent on the oil from the Gulf states. So we're going to start feeling the impact on multiple different products. So I don't think it's going to be hard for them to make the decision, let's just change to Canada or to other countries. But I think it would have to be like this for a long time.
Okay. Andre, we have to leave it there, but thank you very much for joining us.
Thank you. It was a pleasure.
Cheers. Andre Cire is an associate professor at the Department of Management at the University of Toronto and the Rotman School of Management.